positioning itself to be able to support project development companies in a wide variety of areas that are trying to create more value chain capacity development in the economy that will be able to capture or be able to curb the fears that you keep talking about.
My thought is the SEC. You are talking about regulation, and in fact, in your word, you say it's the pillar of the capital market. And in fact, if you look back at most of the problems we're having in capital market of the world, it's all about weakness in regulations. And I can give it to you for some time now. You have upped your game in terms of regulations. You have done so much in terms of regulation. But my fear is this: is that it's always been about regulation has been more focused and more about the capital market operators, more than the broker dealers. What about the listed company? What about the listed companies? Because what we have seen these days, we have seen a lot of weakness about focusing on regulating the activities. This year we have witnessed so much. We have witnessed the company coming late. Most of the reports is supposed to give, they didn't give in time. At the same time, they are coming with a good loss. Investors are crying, and they are nowhere to go. The other time we are having a meeting with Dylan Clark at the NSC, and we put this question to the NSC. And then he said he has reported the case to the SEC. I said, yeah, nothing has happened. If you continue to go like this, even though you are regulating the capital market operators, and nothing is done about the listed company, we are still going to have them. What are you going to do about this? That's my questions.
How will the local project developer will be listed without fear? Because that's about the only hope of the project developers now.
My question is, should we be focusing on competitiveness or should we be focusing on protecting local industry? And to what extent?
My questions are directed at this. You mentioned during the presentation that Nigeria needs to tap into have more creative ways of tapping into the tax potential of the informal sector. Would you have any suggestions around there? You also mentioned that though oil accounts for 10% or less of GDP, but policy is still largely around what happens to oil. So the question is Nigeria hooked on oil, and how do we get out of this cycle?
Lots of questions there, and I think a really important one, which can only benefit from greater local debate, is the way forward to protect local industry. One could argue that Nigerian local industry has already benefited from a great deal of protection over many decades, and what is there to actually show for that? Or should the aim be to try to be more competitive? There will always be people who fall on either side of this divide. When one looks at economic models, a lot of debate: was the Washington Consensus right? Was it correct to just liberalize? Or is there a case for those economies that actually cast away the Washington Consensus, that did their own thing and did provide for import substitution and some degree of protection of local industry, ended up with those local champions? And the truth is that nothing is ever black and white. It's very difficult to point to economic policy and to say, well, something that worked in that place is going to work in this place, and therefore you get exactly the same outcomes. The local context always is important. It always matters. And that's why I think in trying to navigate its way through these very difficult challenges, it's important that the policy debate in Nigeria, first of all, is aired, that everyone who has a view on this is able to put forward their view, and that that dialogue actually does happen. Because the truth is that if you go to any extreme, you're probably going to get undesired consequences. If you have a situation where local industry is so protected, regardless of how competitive it is, you're not going to get the best outcomes for Nigerian consumers. Nigeria faces a demographic imperative. It needs productive industry because it just isn't a choice for the country to have a very low share of manufacturing as a percentage of GDP. when you look at the rising job creation need of the rising population, you can forget the idea that policy doesn't have to be actively engaged with how to bring about these productivity gains. But at the same time, what level of distortion are you going to create? Are you going to put in place so many policies that just go so far against the way people are likely to behave, given the incentives that they face, that you're not going to get optimal outcomes? Are you trying to fight a losing battle? If you find that you're doing that, it's probably the time to rethink policy. So there are no easy solutions. My own training as an economist suggests to me that in the end, no matter how much you try to guard against it, those market forces are always going to end up having an impact. So the question is, how much is the optimal amount of regulation? How much do you fight the natural inclination of markets? Is there a better way? Do you allow for a system with some outlet for the pressure, so long as you can control the overall extent of that pressure? Zambians would tell us allowing your currency to depreciate 50% year to date, just because you've had some commodity price weakness, is probably not the best way to go about it. But then the question is, when you get an intense economic squeeze, an intense squeeze on actual real activity, where jobs are not being created, and manufacturers are saying, well, if we can't get these inputs, forget the best of intentions about doing more to boost manufacturing. If the FX is just not available for us to import what we want, and no one can really micro-regulate that to a great extent, then is Nigeria actually losing out through its policy choices? So there's a very important debate to be had, and I think the answers are not going to be black and white. Nigeria necessarily will have to navigate its way carefully through this, but there are legitimate questions to be asked about how much protection is the optimal degree of protection. At what stage do you think it might be better to allow for a more level playing field and greater competitiveness so that a country isn't continually held back? If there's a strong patriotic feeling that people want to boost Nigerian industry, each one of you as consumers has a choice. You can buy Nigerian if you feel so strongly about it, but does anyone have the right to tell you, we really are going to restrict that choice? How are you going to behave then? I think this is just about drawing out the policy arguments, thoroughly examining both sides of the argument, and I would suggest that the answer is not going to be easy. On a global level, these are questions that economists are still grappling with, and the actual proof that we have globally is there is no one correct model. There is no one-size-fits-all. It's about paying attention to local context and local conditions and thinking, what might be right for Nigeria, given that there's a government that wants to spend more on infrastructure, that needs to get the confidence of foreign investors to be able to make that spending on infrastructure cheaper. Given that oil prices are where they are, would it help or would it hurt to allow for maybe a 5% depreciation of the exchange rate? Would 5% hurt? Would 10% hurt? Would 20% hurt? At what point do you think you need to step back? What is needed is just a great deal more dialogue and debate and the realization that there are no easy answers. The other question, I think, was on the informal sector, and maybe a little bit of backtracking here. I'm one of those economists who used to write consistently that the problem with Nigeria's economy is that it had not been allowed to realize its full potential. Nigeria was very much caught up in being an oil economy. Things were much more expensive than they needed to be in Nigeria. That is what held back competitiveness. And that's partly the fact that in the past, the money was readily available, the hard currency for everything. So you would come to Nigeria, and instead of paying the price for food that you would expect in an economy that should be able to produce it that much more cheaply, you were paying dollar prices that you probably wouldn't be paying in New York or Washington, D.C. That, unfortunately, is the side effect of an oil economy. lower oil prices, especially if those lower oil prices were going to be sustained for some time, would really kickstart the reform process in a holistic way, because there would be no alternatives. To survive, the country needed to start doing things differently. And one of the downsides of the years and years of favourable oil prices is that maybe government got too big. There was no social safety net in place, but there was extensive government. There was big government, government was relied on to hire a lot of people, and that's why it's painful, where suddenly something in the equation changes. Oil prices collapse, government can't afford to continue as it did, but at that precise point, the private sector is not firing on all cylinders. The private sector is nowhere to be seen in the sense of being able to generate the employment situation, the employment gains that will make up for government just not being able to hire people. And this is why I think Nigerian policy needs to be looked at holistically. Listen to the private sector. What is the private sector saying about its own constraints? Because now more than ever, the Nigerian economy will need that diverse input. It's not just about earning oil money and allocating that out. This is the time for Nigeria to move from being an allocation economy, a typical rentier-type economy, where it's just the rents from oil that matter, to being a production economy. In terms of that question, protect local industry or promote competitiveness. In the longer term, local industry that isn't competitive suits nobody. And it's probably not the industry that's going to be generating employment gains. So think about the optimal outcomes and work back. Sometimes difficult choices will need to be made, but one needs to realize what one is giving up in the longer term by not making those very difficult choices today.
I said that regulation is the foundation of the capital market, and that it promotes confidence. You have layers of regulation. Of course, you have the apex regulator up there. You also have the market regulators. You know, in terms of for listed companies, the frontline regulator there is a stock exchange, and any other securities exchange whose securities are registered in those exchanges. It is only where there are problems with those frontline regulators that they bring to the apex regulator. And I also know that the apex regulator in the person of the SEC, you know, has come up with a code of corporate governance, you know, that is expected that if public companies comply on this code of corporate governance, it will really ensure transparency, more effectiveness, and then a lot of information that you need, and all of that you will get.
You spoke about where will the funds come from. I mean, it's simple. It's our capital markets. You know, it's about developing like a national savings plan. We've got the pension reform, but that's not the only place where we can actually have savings. So one of the things FMDQ is doing is like I said, support for economic development. So it's around initiatives like that. But we can't also forget, or we at this stage we're at, we need the government support. So we're trying to develop our corporate bond market. Now, without support from the government in the first instance, that's going to sort of be maybe, it will be difficult to sort of set light on that, and is one of the things as well that FMDQ is working very closely with the governments, with the regulators as well. And what we also need to recognize and understand is that the SEC, with this sort of new stance about developing the capital markets, is obviously going to go a very, very long way. You also spoke about exit, and I think that's something that is very, very important, and having an enabling, vibrant secondary market. Without that liquidity, then you're not actually going to be able to get those funds, because every investor wants to know that they have a way out if they needed to come out. So, I mean, we can't emphasize the initiatives FMDQ is going into to provide liquidity in the secondary markets. And I think the costs also of listings, if we can actually get to that point, is something that we're looking at as well. It's quite expensive at the moment to raise capital in the Nigerian market, and that's one of the things as well that we're looking at, even not just as FMDQ, but as a capital market as a whole. you know, from FMDQ to NASD to even the NSC. And there's potential in our market, and it's about galvanizing that and sort of, you know, putting the foundations in place for us to actually develop. And last but not least is education. I think maybe every Nigerian knows about equities, and I'm talking from a debt capital market perspective. Every Nigerian probably knows about equities and knows that you can invest and just buy shares. But there's a lot more as well. It's about building that awareness, and that is something that I think FMDQ as well as NAS is actually really focused on.
I think my contribution is going to be directed at SEC, especially in the areas of market development. In an era where agriculture and solid minerals is going to form a major driver of economic development based on the Buhari doctrine, I think it's important that the capital market aligns with that doctrine by one, making sure that we have commodities exchanges that are connected to the value chain around agriculture and mining. Now, 2 years ago, when we had this conference, there was no FMDQ and NASD. So we have seen market development around the OTC market, even though I believe there are gaps that the SEC, working with the Corporate Affairs Commission, can fill with regards to number of tradable stocks in the OTC market. I think from a developmental standpoint, when we come here in another 1 year, we should have 2 or 3 commodities exchanges that are connected to the entire agri value chain. If we can't achieve that in the next 1 year, then we'll have fulfilled a major part of our market developmental. The other issue which the lady from FMDQ raised has to do with savings mobilization, a national savings agenda. I think in the communique that they issued after their conference, there was a major line that had to do with a national savings agenda. I think for us to mobilize foreign investors, we have to mobilize local savings. So I think SEC as a regulator, AIHN and other market trade groups, I think savings mobilization is something that we need to really address from the standpoint of collective investment schemes, insurance, pensions, and other special banking products around mortgages. Savings, we must mobilize savings in every way possible. So I think that should be the most important agenda. Mobilizing savings and making sure that we have market platforms that are connected to agriculture and solid minerals.